Welcome back to Investing Talk Podcast.
Today we're looking at NBIS Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When we talk about the architecture of the modern economy, NBIS Group is really sitting right at the foundation. They're an established leader in what is probably the most crucial technology layer right now, AI infrastructure and high-performance cloud computing.
Okay, but that's a really crowded space, right?
It is very.
I mean, every company out there claims to be an AI leader. So what makes NBIS Group actually different? Where's the real competitive advantage? The moat that investors always talk about.
Right, the moat. And theirs is, well, it's deep and it's highly technical. It isn't just about selling generic cloud space. It's about their specialized proprietary technology. They've developed these AI-driven data processing capabilities that are just vastly more efficient than the standard solutions out there.
So for clients that are like training massive language models.
Exactly. For them, NBIS is providing the high-speed clusters and the specialized algorithms that make it all feasible and scalable. That efficiency is the key to locking in those big enterprise clients.
And that theory, I mean, it's showing up in the numbers, right? This isn't just a story.
Oh, absolutely. It's translating directly to the bottom line.
I was looking at their Q2 2025 filing, and wow, revenue growth was what, 32% year over year?
32%. And in this sector, even high single-digit growth gets celebrated. So 32 it's a huge sign of accelerating demand for what they do.
And it seems like it's quality growth, too, not just buying market share.
That's the other piece of it. We often see tech companies just burn cash for growth, but NBIS is holding firm. Their gross margin is an impressive 59.12%.
Wow.
And even after all expenses, their net profit margin is still standing at 31.43%. To keep your profitability north of 30% while expanding at that rate, it really shows superior operational control and pricing power.
Okay, so when a company is growing that fast, especially in something so capital intensive like AI infrastructure, you have to look at the foundation. You have to look at the balance sheet.
And their balance sheet is just extraordinary. It's so robust. You really rarely see liquidity ratios this high.
What are we talking about here?
If you look at both the current ratio and the quick ratio, they are identical. They're sitting at 6.57.
6.57. So for our listeners, that means they have over $6.50 in liquid assets for every $1 of debt they owe in the short term.
Exactly. And the fact that those two ratios are the same tells you they don't rely on inventory. It's all cash, investments, and receivables.
That's a huge war chest. It gives them massive financial flexibility for R&D, for expansion, whatever they need.
It's less about hedging and more about strategic deployment. When a major new ship architecture comes out, they need to be able to acquire and integrate it immediately. This lets them move faster than competitors who might need to line up financing.
Okay, so they're liquid, but are they stable? This is a volatile market.
Well, their leverage profile helps answer that.
Uh-huh.
The debt-to-equity ratio is manageable at 85.4%. But the real number to look at for risk is the Altman Z-score.
The Altman Z-score. Can you just quickly break that down? What is that telling us exactly?
It's basically an algorithm that combines 5 key financial ratios to predict the probability of a company going bankrupt within 2 years. A score below 1.8 is considered risky. A score above 3.0 is the safe zone. NBIS' score is 3.46.
So they're firmly in that safe zone. They're built to withstand some market turbulence.
Precisely. They're expanding aggressively, but they're disciplined about managing financial risk.
Which brings us to the next, maybe the most important question. We've got a market leader with a tech advantage, accelerating profits, rock-solid balance sheet. What's the price tag?
Naturally, the market sees all this.
Right.
Analysts have been scrambling to play catch-up, raising their expectations. They've significantly boosted their 2025 earnings per share estimates to $2.03. Just a few quarters ago, that number was 94 cents.
That's a massive leap. It shows analysts expect this profit growth to accelerate even more.
It's a tremendous vote of confidence.
But confidence has a price. And here's the big one, the major caveat. The forward price-to-earnings ratio is sitting at an eye-watering 403.48.
Yeah, that number it's not just high. It signals the market is pricing in near perfection for the next 5 years. It means investors are betting that NBIS will continually not only meet, but beat those already high estimates, quarter after quarter.
So how do you even reconcile that? A fantastic business, but a valuation that feels astronomical. It's like you're paying for 5 years of growth today.
That's exactly it. The risk is basically inverted now. If they just meet estimates, the stock might go nowhere. If they miss, even by a tiny bit,
The punishment will be severe.
swift and severe. There is almost zero margin for error priced in.
So let's look at how the market's actually trading this. What's the technical picture telling us?
Well, it shows clear, persistent buying interest. The stock's in a solid bullish trend, printing higher lows and higher highs. It's trading around $95 as of mid-November.
And it seems to be consolidating within that trend.
That's right. Over the last 3 months, it's been in a pretty robust range between about $90 and $118. It's a healthy upward channel.
And what are the momentum indicators saying?
They reinforce it. The stock is comfortably above its key moving averages. The 50-day is at about 110, and the long-term 200-day is way down at 59. That spread signals a strong structural uptrend.
Okay, but what about the relative strength index, the RSI? Is this rally getting overextended?
That's what's so compelling. The 14-day RSI is currently around 30.50.
30.5. So for listeners, the scale is 0 to 100. Over 70 is overbought, below 30 is oversold. So what does that number tell us?
It's a very healthy sign. It means the stock has pulled back a bit, but buying pressure has stepped in and prevented it from becoming truly oversold. It suggests strong accumulation is happening on any dips.
And this isn't just retail money, right? We're seeing insiders and institutions moving in.
Absolutely. Insider buying is a powerful signal of internal confidence. But the institutional money is key. We saw Orbis Investment Management, for example, disclose a substantial increase to their position back in September. When that kind of big, sophisticated money comes in, it provides stability.
Okay, so that's the setup. Let's talk catalysts. What's happened recently and what's coming up that could move the stock?
In the last 3 months, the August Q2 earnings release was huge, not just for the growth, but for the focus on those improving gross margins. And then there's the tech rollout, the expansion of NBIS AI and this new thing they call the Token Factory initiative.
The Token Factory, what is that and why should we care?
From what we can tell, it's a framework for managing and tokenizing their computational resources. Essentially, a secure way for clients to pay for and use compute power for really sensitive AI models. It's building infrastructure for the next wave of AI.
And they just filed to raise more capital, too, which signals they've got big plans.
Exactly. So looking ahead, the next 3 months are critical. The first and most important trigger is Q3 earnings, expected around February 10th, 2026.
And with that 400 PE ratio, that releases everything. They need to show acceleration, not just continued growth.
Right. And the second key date is even sooner, the ETF rebalancing on December 15th.
Ah, so if they get included in a major index.
Then all the passive funds that track that index are forced to buy the stock. It can drive a ton of volume and be a really powerful short-term catalyst.
And of course, there are always rumors.
Oh, the market buzz is heavy right now. Lots of chatter about potential partnerships with the global hyperscalers. You know, the biggest cloud providers in the world.
That would be a massive validation. Any M&A talk.
Yep, rumors they might be looking to acquire smaller firms to consolidate their market share even faster.
But on the flip side of that, with such a high-stakes earnings report coming up, you'd expect to see some skepticism.
And we are. We're seeing reports of rising short activity. It's almost certainly traders hedging against that sky-high valuation. They're betting that even a great report won't be enough, or that a slight miss will cause a huge drop.
So we come full circle back to that central risk. The valuation demands perfection. Management seems to be mitigating the company's specific risks very well.
They are. The risks right now are almost entirely about market expectations, not fundamental business problems.
So, given all this, the strong fundamentals, the upcoming catalysts, but also that intense valuation pressure, how should someone think about this? Is it a short-term trade or a long-term hold?
You know, it's a compelling case for both. For a short-term trader, you're looking at the ETF date in December and earnings in February. Those will drive volatility. For a long-term investor, you're buying into the entire AI economy's structural growth, and you're betting that NBIS can grow into this valuation over the next 3 to 5 years.
It really is one of the most fascinating high-growth stories out there. The foundation's solid, the strategy is clear.
But the market has already priced in a lot of that future success.
Which means the margin for error is non-existent. All eyes has to be on that Q3 earnings day around February 10th. If NBIS shows any sign of slowing down, the price paid for this stock will ensure that correction is brutal. The penalty for missing expectations here is just incredibly steep.